I believe in today's investing world, many new investors make this mistake, and the mistake is essentially just not having a plan. I believe it is important to all investors, long term investors like myself who have a 30 plus year time horizon, to have a strong investing plan. And what new investors usually do is they usually look at new stocks, talk to their friends about stocks. For example, like a stock like Apple, they put a lot of money in Apple, but they don't understand how is Apple going to grow in the next 5 years. What do their numbers look like, and what does Wall Street predict for Apple, and if they're beating earnings and all that stuff. And it can become kind of overwhelming at first, but it's not as overwhelming as you think it is because of all the tools we have in today's investing world. And in today's video, I'm just going to go over my strategy and how to know when to invest, like a company that could beat the S&P 500 in the long haul, and companies where you shouldn't be investing in if they're just going to match it, and why that is. My strategy when it comes to investing is to invest in these individual companies that I believe will outperform the S&P 500 over the next 5 years. In fact, the worst case scenario, and I've done models for all these companies, is if they, in the worst case scenario, they should be able to match the S&P 500. And that's why I do in all my individual holdings. And about 20% of my portfolio is in the S&P 500 in itself. And just as a reminder, I'm 20 years old, so I have a long time horizon, so I can have a little bit more beta in my portfolio. And beta just means your portfolio is going to swing either higher or lower than what the market's doing. So it's a little bit more volatile, a little bit more risky. But because of my long time horizon, I could definitely stomach it. Now, you may be wondering, why is Amazon in my portfolio? Why Google? Why Microsoft? It's because at the rate of these companies, how fast they're growing their earnings per share, and I'm going to show that later in this video with charts, it becomes reasonable to believe these individual companies will outpace the S&P 500. And if they don't, I'll just sell and then add it to my main position of the S&P 500. But selling in itself is a whole different topic, and I'll have future videos on that. It's kind of complicated when it comes to selling, and too many people short sell. If you're going to hold a company, you should be able to hold it for a year. Otherwise, you're going to get taxed a higher rate. But long term investing, if you hold a company for over a year, you only get taxed 15% for gains, and it doesn't count as income. So it's definitely something new investors don't understand and is definitely important too. Now, a company that a lot of new investors will invest in when they open up a new brokerage account is actually Apple. It's like one of the most common companies people put their money in. And I'm not saying Apple's a bad company, but I'm going to be sharing why you should just put your money in an index fund with a bunch of companies with lower risk rather than a company with a lot of beta like Apple. Because what a lot of people don't understand is a company like Apple or Tesla or these popular stocks that new young investors in their early 20s, someone like me, putting a lot of money in, they don't realize that Apple, they're not really growing their revenue over the last 5 years by that much. In fact, over the last year, they've only grown it 2%. And in the next 5 years, they're only projected to grow it by 4%. And that's not really good. In fact, their earnings per share growth is also flat lately. So in the next 5 years, if this company is going to, if their stock price is going to go up, their price to earnings ratio is going to have to go up. And this company's already trading at a 32 PE ratio. It has gone down lately because of recent news, but it just doesn't seem like a great company for me because of the potential it's having with its phones and stuff. In fact, the only segment that's growing over 10% in revenue for Apple year over year is their service segment. So think like the App Store or the app music, things like that require like a monthly subscription. That's the thing Apple's trying to push, but most of their revenue is still coming from the iPhone. And as investors, you have to realize that the iPhone kind of seems mature. It seems most people upgrading to these new phones, it's just had a maxed out capacity where Apple's going to have to rely on something really innovative or Apple Intelligence to push out these phones more. Now, one good thing about Apple is in this chart, you can see that their earnings per share growth, you can see the blue dots represent represents Apple's earnings per share, while the gray dot represents the estimate of Apple, what Wall Street thinks Apple would earn. And you can see most of the time Apple beats on the estimate, which is good. You want predictable companies that usually do beat on this estimate because it makes predicting the company in the future easier. And Wall Street predicts Apple can grow its earnings per share, we'll say like 6% over the next 5 years. So what does that look like? Well, if you think Apple's going to grow 6% year over year for the next 5 years, and say they trade at a 35 PE price to earnings ratio, which is, in my opinion, this is the best case scenario when it comes to Apple. This is, I believe Apple cannot grow quicker than this. And I think the premium, the ending 35 PE, this is like the best case scenario for Apple. And with all that, you're still only going to get 8% year over year returns for the next 5 years. In the S&P 500, it usually averages about 8 to 10% anyway. So like, why not put that money instead in the S&P 500 where you own a bunch of companies and you're more guaranteed to get that return? Because something could go wrong with Apple, their price to earnings could drop. They may not grow their earnings per share by 6%, which is already low in itself. And you want to look for companies that can at least get 15% year over year. That way you're hedging from the S&P 500 to outperform it. So if we look at my portfolio right here and we just go in the tech sector, you can see I don't own Apple. One company I do own though is Google. Now you may be wondering why Google, they're a big company, and why you not own Apple? Well, Google, if you look at the fundamentals, which I'll pull up, for one thing, Google is trading at a lot lower valuation than Apple. Their trailing 12 months valuation right now for the price to earnings is only 19. And their forward PE ratio is 17, which for a company like Google, that is extremely cheap. You can see too that Google is growing their revenue by over 10% year over year, unlike Apple, and they're going to continue to do that in the future. And more of this revenue is going to the bottom line, which gives Google operating leverage. And Google has so many assets. They have the Google search business, and that's most of the revenue. And that's why many investors are scared of Google, why their price to earnings is at a lower valuation than what it should be, because people are scared of the LLMs, the chat GTPs, the Gronks, that they're going to take over Google search. But I believe Google search is actually going to get stronger because of the LLMs. You have Gemini, which is Google's LLM, and they're pouring a lot of capex into that. And Google has this moat, this ecosystem where people are already locked into, and it's going to continue to grow. In fact, since ChatGPT has came out, Google search has still grown 13% year over year, and we see the growth of it not slowing down. So I don't see this as a concern. They also have YouTube, and YouTube in itself can be a massive business just on its own. And you have the subscriptions, their cloud business, which is now profitable, which you can see in this chart. And that's going to keep scaling too. And you have their Waymo, which is their self-driving cars. This company just has so many more assets, in my opinion, than Apple. And Wall Street expects this company to grow their earnings per share by 15% year over year. We're going to see what that looks like. So if Google can grow their earnings per share by 15% year over year, and say they have an ending PE of 22, it means year over year you're going to get 17% returns. And this is what I believe Google will do in the next 5 years. And say they don't do as good, say they only do 12% growth. Well, you're still going to get 14%. And say they only do 10%, you're still going to get 12% year over year returns. So even in the worst case scenario, I see this company at the very minimum at least matching the S&P 500. And that is exactly what my strategy is. If we go back to my portfolio, my holdings, I believe all these companies, their best case scenario will outperform the S&P 500, and their worst case scenario, they're going to match it. That's why I'm investing in it. And in the long haul, if it doesn't happen, then I'm just going to move the money over towards my main position of the S&P 500. So there you have it. That's really mainly the video for today. If you liked it, please comment, subscribe, leave a like. It helps with the YouTube algorithm. It helps motivate me keep making these videos, and it'd mean a lot if you would do that. The main takeaway of this video is if you're someone new to investing and you want to invest in individual companies, you can easily do it. And I'm going to have more videos in the future of things like what to look out for, like the net income, things per share, the free cash flow of the businesses, like the differences between all that. I'll try to have videos out in the future of that. I am currently getting a degree in this stuff, so I am learning as I go. And I really want you to comment what you've learned if you have experience, because I'm trying to build a community of long term individual company investors. And that's going to be it for this video. And I'll see you in the next one.